Intercompany transfer of services and non-current assets. In this learning objective, we're going to continue our example with the downstream sale of land, but we're going to look at year 2 and beyond. And since we're going to only focus on the items of importance in this learning objective, we're going to consolidate the equity method of accounting and consolidation accounting into one learning objective and just focus on the entries that are specific to us. Here's the information. The sub continues to hold the land all the way through till March 4th of the 4th year. So what happens during X2 when we have the activity between the parent and sub? Well, there's nothing that we need to do for the special allocation because remember the deferred gain or the unrealized gain occurred for year 1. So we have nothing to consider for the equity method of accounting in year 2. But we have to make some EJEs in year 2, 3, 4 until the land is sold. And what we must do, because remember that the EJEs don't necessarily post to the parent's records or to the sub's records. So once we consolidate, they get posted for consolidated financial statement purposes, but they don't stick or post permanently to anyone's records. So we're going to have to continue to make certain EJEs until the transaction is completed and sold to third parties. And this is one of those. A good guide for us is what do we do the first year? If you remember correctly, we debited gain on sale of land and credited land for $45,000. Where do revenue and expenses go when they close out? You should know by now that they go to the investment subsidiary account. So the gain on sale of land is a revenue/expense account. So what we're going to do is, since we must continue to make this EJE because we still hold the land, we're going to have to make this EJE each and every year until the land is sold. So from year 2 and beyond, we're going to put the gain on sale of land or reclassify it to investment sub. So we'll make this entry here for year 2 and 3. In year 4 the land sells, so we'll do something a little bit different, which we're about to see. The land sells in the 3rd year to a third party, and it sells for $160,000. We see that the subsidiary has a gain of $90,000 on the transaction, of which this $90,000 will be included in the net income sub, which the parent will share in. The subsidiary will make the following entry to record the sale. So that leads us to what do we need to do in the 4th year? Because remember, we had some deferred gain, $45,000, that we can now recognize as an actual gain because that land has been sold to a third party. So what are we going to do? In the 4th year, since we know that the land is sold, the parent will make the following entry to recognize that deferred gain that they had in X1. So they're going to debit the investment subsidiary, credit income from sub, which is going to increase the income from sub for $45,000. Well, that brings us to the consolidation accounting during X4. Let's take a look at 2 EJEs that we're going to need to make. The first is any unrealized gain or loss that we may have, and that is to account for the equity method journal entries that we made. If you remember, this is what we just did. We recognized the gain during the current year through the income sub account. So to eliminate that, we need to make the following. Debit income from subsidiary, credit the investment sub. At this this point, that deferred gain that we were just allowed to recognize during the year, we've undone the effects of that. So on the consolidated financials, there is no gain that is out there, and we're entitled to recognize that gain. And in fact, for consolidated purposes, we should recognize it because that transaction has been completed. Well, what did we do with that deferred gain entry in year 2 and 3? Remember, we debited investment sub, credited land. And what that did was it restated the land to its value of $25,000. Well, the land is no longer there because it has been sold. So we need to do the following. The land's gone, but we've eliminated that deferred gain that we recognized. So what we need to do now is we need to recognize in consolidated net income that deferred gain that has actually become from deferred, it's now realized. So what we're going to do in X4 is we're going to debit investment sub, and we're going to credit the gain on sale of land for the deferred gain that is now realized. If we clean that up, this is what we get. And we recap, and we had 2 entries that are related to that. And what's going to happen in this particular example for consolidated net income is that unrealized gain of $45,000 should now be included in separate operating income when we compute our consolidated net income. So if it's deferred, we subtract it out. Once it's actually realized or has come to pass, we'll include it in the separate operating income.